The stock market recently has been going crazy and not in a good way. And if this is concerning to you, if you're watching this video, it probably means that you're concerned about the market as well. And this video is for you. My name is Kyle Demian from the Wealth Academy. And in this video, we're going to be talking about what the recent stock market volatility means. And this video is specifically going to be geared towards those that are getting close to retirement. And getting close to retirement, we usually say within about 10 years or so. Reason being is some of the largest crashes in the economy have taken anywhere from 7 to 13 years to recover one. And the average market decline takes about 7 years to recover, according to the data from JP Morgan Chase. So if you're within about 10 years, that's why it is so important to be properly diversified, which is what we're going to talk about today. Now, this video isn't intended to be financial advice, simply just education, information, and my thoughts and opinions on the market. So always seek professional, one-on-one help for anything, especially financially related, before you make any financial decisions. So with that, at the time of this recording, which this will be very important, depending on when you're watching this, but right now it is Tuesday, April 8th, and the stock market just opened as of today. But what we're going to talk about today is just the stock market over the last couple of months. And so let me share my screen here, and we're going to go into it together, and we're going to look at what some of this may mean for you. And now to do that here, I'm going to go ahead and pull up my screen and share with you what we have and what we call our financial forecaster. So this financial forecaster does a lot of awesome things, and simply enough, it helps us calculate retirement income, taxes, growth, and so on to help people with their retirement income strategizing. So I've talked to a couple of people in the last couple of weeks that have been just simply okay with where they're at and just telling me, hey, I'm going to ride it out. I'm going to stay where I'm at. I'm going to stay invested in the stock market and reach out to me when the market rebounds and comes back up. And the number one problem with that statement, I think, is simply just the assumption, in whether they realize this or not. But also, if I take a step back, I understand it. When things are this volatile, you don't want to make any changes. You kind of just want to stay where you're at. When there's a lot of volatility in the market, maybe it just seems more comforting to stay where you're at. But here's the potential scenario that I see, which we don't know. And because the stock market, this is actually perfect, because the stock market is down about 11% so far year to date, and so far today it's had a good day. It's ticked up a little bit. But because the stock market is down 11% year to date, if you were to say you're just going to stay where you're at, you're going to stay invested in the stock market because you've taken some losses and you don't want to lock in your losses, I want to warn you just the fact that you are making the assumption that we're only going to go up from here from today on out. And here's what I mean. You're basically putting yourself in the year 2000, where the market was down 10% in the year 2000. If you would have just stayed there saying, oh, I'm going to wait it out, I'm just going to wait until I get back to the point I was before. What you didn't realize, what you didn't see coming, was another 13% loss in 2001 and a following 23% loss in the year 2002. So where you were only down about 11%, you lost another 36% on the back end. And what that looks like in financial numbers, let's say you had $1 million in your account. After 1 year, you're down 100,000. You've lost a little over 10%. After these 3 years, you're down over $400,000. Right? And here's the crazy thing about the early 2000s. If you did truly want to wait to get back to that point of you breaking even, you didn't want to take any losses. Here's 2003, a great year of growth, but you're still only at 756,000. Here's 2004, 9% growth in a year is pretty good. That's $824,000. 3% growth, you're still only at 850. 2006, we had a 13% growth year. That's a good year, but you're only at 965,000. And interestingly enough, here at 2007, you had a 3% growth. You're almost back to that $1 million that you started with. But then here, 2008 happened. You lost 40%. Now you're back down to 600,000, where you were back in 2002. But now it's 2008. And here's 2009, 2010, 2011, 2012. It's not until somewhere between 2012 and 2013 that you actually got to break even. And so that's the problem. That's the risk that you run, as I see, with being right here potentially at the beginning of another huge market crash. Seeing where the market's at today and just saying, hey, I'm going to stick it out and I'm going to wait until I get back to my break even because I don't want to sell and take any losses. Hypothetically, that sounds like a good idea. We've all heard it. Don't sell, don't take your losses. That's for people that are in the accumulation phase. If you're in your 20s, 30s, 40s, maybe even early 50s, that's okay. It's okay to take these losses because you're still contributing and putting money into the market, right? So the market goes down and you're still putting a bunch of money in. You're buying the market, you're buying the stocks and stuff when the costs are lower. You see what I mean? You get a discount. And so you're putting money back into the market when it's at its low points. That makes sense. When you're in that preservation and protection phase, no, it doesn't. You expose and put yourself at too many risks, and the main risk being that you don't get to retire when you want to, or you have to delay your retirement, or God forbid you're already retired and you're just retired maybe, and you're finding yourself, maybe retiring in 1998, 1999, and here, maybe this 2000 years, one of the first few years of your retirement, you run a huge risk of potentially running out of money in retirement, right? And here's what I mean by that. Let's say I wouldn't tell you guys to do this. The safe withdrawal rate purposely is 4%. But if you were to have a 5% withdrawal rate and you're losing money from your accounts and you're taking out 5% per year, this is why you can't have a 5% withdrawal rate. There's a risk that you run of running out of money in retirement. 20 years into retirement, you're dead broke. You're out of money. You're going back to work. You retired at 65. Now you're 85 and out of money and out of assets. This is why retirement protection is so key and is so important. And most people don't even realize that there are indexed accounts that are out there that don't expose you to any of these risk of losses. So if the market goes down 10%, goes down 13%, goes down 23%, you simply just earn a 0% rate of return for that year. You don't lose any money. But when the market goes back up, you take part in some of the growth. Now you're not going to get all of the growth because you have none of the risk, you have none of the downside. So that's like the give and take. You give up all of the upside growth to have none of the downside losses. And over time, looking at this period of time, this would have been really great for this investor, this person in the market, protecting and preserving their $1 million. And so I got to ask, as you're getting close to retirement, you have to ask yourself, at what point is enough enough? Because you don't have the time on your side. A 10% growth on $1 million is only going to get you to 1.1 million. But a 30 or 40% loss can take you back to $600,000 or $700,000. And you may not have the time to be able to wait for that to bounce back up. So you got to ask yourself, at what point do you just lock in the gains and lock in the growth that you've probably spent the last 30, 40 years of your life accumulating and building up, And we like to fall back to just a rule of thumb, or what we call the rule of 110, which gives us an idea of about how much risk you should be taking. And simply enough, you take your age and you subtract it from the number 110. So 110 minus 60, let's say you're 60 years old watching this, would be the number 50. That tells us that 50% of your money, based on this rule, should be at risk in the market, while the other 50% should be risk off. Now, depending on you and your goals and how close to retirement you are, you may be more conservative than that. You may be more aggressive than that. But if you are more conservative or more aggressive, you got to make sure that your money matches what you need it to be and what you need it to feel like. And as I was just looking at this, I realized, yeah, you're still technically losing a balance here because there's withdrawals. But if I take that off, just to show you guys purely just the accumulation and the difference side by side, and just to highlight that these indexed, these are just called index strategies. There's a few different ways to get this, kind of protected growth. But simply enough, when the market goes up, yes, you take part in some of the growth. When the market goes down, though, you lock in any prior gains and you don't take any of the losses with the accounts. And so with that, I'm going to wrap up this video here and this message here. If you guys have any questions on this, number one, drop your questions below in the chat. I do read the questions and have made videos before based off of some of the questions that you guys have left. And also, if you guys are watching this and have concerns over the market and want to talk about some of these index strategies to protect your money, I'm going to leave a link below to the website, thewealthacademy.com. You could go there, schedule a time to meet, and we could talk about protecting and preserving, some of your money as you're getting close to retirement. And if you guys found this video helpful, make sure to leave a like. If you guys are getting close to retirement, that's all that I talk about on my page, are safe retirement strategies, what to watch out for, and how to live the best retirement possible. So if I could be of any assistance, I would love to help you guys, and we'll see you guys on the next episode. Take care.